Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Now that we've covered the basics, let's dive deeper into how you can strategically invest in global bond funds to maximize returns and reduce risks. Risks and challenges of global bond funds. Investing in global bond funds can be a great way to diversify your portfolio and earn regular income. However, like any investment, it comes with its own set of risks and challenges. As you consider adding global bond funds to your investment strategy, it's essential to understand these potential pitfalls. So, what are the main risks and challenges associated with global bond funds? Let's take a closer look. Interest rate risk. Changes in interest rates can significantly impact global bond funds. When interest rates rise, the value of existing bonds with lower interest rates can decrease. This is because newly issued bonds with higher interest rates become more attractive to investors, making older bonds with lower interest rates less desirable. For example, imagine you invest in a bond with a 5% interest rate. If interest rates then rise to 6%, the value of your bond may decrease because investors can now buy new bonds with a 6% interest rate. To mitigate this risk, you can consider investing in bond funds with a mix of short-term and long-term bonds. This way, you can take advantage of higher interest rates when they rise, while minimizing the impact of interest rate changes on your overall portfolio. Some strategies for managing interest rate risk include investing in bonds with shorter maturities, which are less sensitive to interest rate changes, diversifying your bond portfolio across different sectors and regions, considering bond funds with an active management approach, which can help the fund manager adjust to changes in interest rates. Credit risk. Credit risk is another significant challenge associated with global bond funds. This type of risk occurs when a bond issuer defaults on their payments, either partially or fully. To assess the creditworthiness of bond issuers, you can look at their credit ratings, which are assigned by rating agencies such as Moody's or Standard & Poor's. These ratings give you an idea of the issuer's ability to meet their debt obligations. For instance, a bond issuer with a high credit rating is considered to be more likely to make their payments on time. When evaluating credit risk, consider the following factors. Credit ratings. Look for bonds with high credit ratings, which indicate a lower risk of default. Issuer quality. Research the bond issuer's financial health, management team, and industry trends. Bond covenants. Review the terms and conditions of the bond, including any provisions that may protect investors in the event of default. By understanding these risks and challenges, you can make more informed investment decisions and develop a strategy that works best for your needs and goals. Tax efficiency of global bond funds. When investing in global bond funds, it's essential to consider the tax implications of your investments. Taxes can eat into your returns, reducing the overall performance of your portfolio. So, how can you minimize tax liabilities and maximize your after-tax returns? The key is to understand the tax efficiency of global bond funds and develop strategies to reduce your tax burden. Tax-deferred accounts. Tax-deferred accounts such as 401k and IRA can help reduce tax liabilities. These accounts allow you to postpone paying taxes on your investment earnings until you withdraw the funds in retirement. By investing in global bond funds through tax-deferred accounts, you can defer taxes on interest income and capital gains, which can help your investments grow faster. For example, if you invest $10,000 in a global bond fund through a 401k and earn 5% interest, you won't pay taxes on that interest until you withdraw the funds. This can be a great way to reduce your tax liability and maximize your after-tax returns. Some benefits of using tax-deferred accounts for global bond funds include tax-deferred growth. Your investments can grow tax-free until you withdraw the funds. Reduce tax liability. By postponing taxes on interest income and capital gains, you can minimize your tax burden. Increased after-tax returns. By reducing your tax liability, you can keep more of your investment earnings. Flexibility. Tax-deferred accounts offer a range of investment options, including global bond funds, to help you achieve your financial goals. To make the most of tax-deferred accounts, consider the following strategies. Contribute as much as possible. Maximize your contributions to tax-deferred accounts to reduce your taxable income and minimize your tax liability. Choose tax-efficient investments. Select global bond funds with low turnover rates and minimal capital gains distributions to minimize tax liabilities. Monitor and adjust. Regularly review your investment portfolio and adjust your strategy as needed to ensure you're making the most of tax-deferred accounts. Global bond funds. As we've explored the world of global bond funds, it's clear that they can play a significant role in a diversified investment portfolio. By investing in bonds from companies and governments around the world, you can spread your risk and potentially earn higher returns. But what are the key takeaways from our discussion? Key points to remember. We've covered a range of topics, from the different types of global bond funds to the risks and challenges associated with them. Some of the most important points to remember include the benefits of diversification. By spreading your investments across different countries and industries, you can reduce your risk and increase your potential for long-term returns. The importance of understanding the different types of global bond funds. From government bond funds to corporate bond funds, each type has its own unique characteristics and risks. The role of active management. A skilled fund manager can help you navigate the complexities of the bond market and make informed investment decisions. The need to consider tax efficiency. By investing in tax-deferred accounts and choosing tax-efficient investments, you can minimize your tax liability and maximize your after-tax returns. Final thoughts. So, why should you consider adding global bond funds to your investment portfolio? The answer is simple. They can provide a unique combination of income, diversification, and potential for long-term growth. By investing in global bond funds, you can tap into the growth potential of economies around the world and earn regular income. And by doing your research and developing a solid investment strategy, you can minimize your risks and maximize your returns. As you consider your investment options, remember that global bond funds can be a valuable addition to a diversified portfolio. They can help you achieve your financial goals and provide a sense of security and stability in uncertain economic times. With their potential for income, diversification, and growth, global bond funds are definitely worth considering. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.